Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Hormuz Fatakia in the green after 3 consecutive days of losses. The Nifty and the Sensex up by a smidge, just up close to about 0.2%, but there is action and traction and momentum in the broader market. So the mid-cap index is up 0.7% and a very strong advanced decline ratio. 3 stocks gaining for 1 in the red.
It's a very good start after a holiday, and especially the broader markets. We were mentioning it last week as well, right? The broader markets are giving some hope even when the Nifty and the Nifty Bank were grinding lower. See the 0.7% higher for the mid-cap index. The small-cap index is doing even better. It's up 1% now. And we were highlighting last week that there are certain sectors that are doing well, regardless of the fact that the Nifty and the Nifty Bank are not doing so well for themselves. The metal indices are doing well. The metal index is up almost 1.5% as we speak. And as is the PSU Bank index. Remember, the PSU Bank index was among the top losers in Tuesday's trading session. So that was one of the index that did not do well. So that is seeing a bit of a rebound. What is also doing well is the real estate index. That was also among the top losers. Some of the high beta names there coming out with business updates, Brigade Enterprises, Suntech Realty, those stocks doing well. The Realty Index almost up 1%, and the IT Index is up 0.4%. The Brigade, there you can see 5.5% higher there. But IT, as we were mentioning, a pain point for the markets, Reema, after the TCS results, the sell-off just intensifying. And now with Infosys coming out with numbers today, the IT Index is now up 0.5%. And almost seems as if it's on the edge, right?
Oh, absolutely. I think there is some concern going in terms of the FY25 guidance. Will they guide very conservatively? Infosys is on the edge. And as you pointed out, the stock has been down close to about 4 to 5% this week. But let's get to the other big story that we're tracking, and that's power. Power Grid is one of the top Nifty gainers on the back of some news flow as well as brokerage commentary. There is a Goldman Sachs note. Vivek joins in for details. Vivek.
Well, that's right. So Power Grid is the stock in focus. We've been highlighting and talking about how for India to go ahead and have a significant transformation as far as its entire grid is concerned, there will require to be a significant amount of investment that will be put as far as the transmission space is concerned. So Power Grid, especially in FY24, has been seen as emerging as the lowest bidder in multiple transmission projects that have come up for bidding. So again, day first day, the company gave an update to the exchanges regarding 3 projects that it had won, and these were under the TBCB route, or the tariff-based competitive bidding route. So which were the 3 projects that it has won under the BOOT model? The first one is for transmission system for evacuation of power from Rajasthan SEZ. It has won 2 projects over. One is Section C and the other one is Section E. Also, it has won a transmission system for evacuation for power from renewable energy source. Now, this is from the Khavda Renewable Energy Project in Gujarat. Now, along with that, today, a very interesting note from Goldman Sachs. They've written on the entire capex requirements that would be required to be made over the next 25 years as India transforms its entire power system. And their top pick is Power Grid. They have a buy rating on the stock. Their target price is at close to 355 rupees a share. They say that the company is India's largest transmission asset developer, and that is why it's their top pick. It is a play on the grid capex super cycle with a very large balance sheet that the company enjoys. The company also has the ability to fund close to 30% of India's FY24 to FY32 grid capex while continuing to maintain its current dividend payout. And lastly, it also says that the company has structural funding advantage and consistency that it can generate as far as its core regulated earnings is concerned. On the back of all of that, you're seeing quite a bit of traction in Power Grid today.
The silent mover is Power Grid, not as noisy as its peers like REC and PFC, but 65% in the last 12 months is Power Grid, along with the bonus issue, I guess, as well. So you pull up a 1-year chart for Power Grid, and there you can see it's quietly gone about its business. There you can see 60% higher in the last 12 months, and on the note there, bullish commentary coming in from Goldman Sachs, so 4% higher in today's session as well, almost 285 now on Power Grid. The other stock that is doing well today, and that is on the back of earnings, is ICICI Lombard, and that is up almost 4% now after its 4th quarter results. Yash is in with the fine print. Yash, how are the numbers? I guess the stock is reacting to some good numbers.
Well, Hormaz, you spoke about things being noisy, and as far as the Q4 results for ICICI Lombard are concerned, they were quite noisy. We've been talking about these numbers month on month and telling our viewers that ICICI Lombard's premium collection was constantly outperforming the industry average, and the same has reflected in the fourth quarter as well. So as far as the fourth quarter net earned premium is concerned for ICICI Lombard, that grew by about 17%. The industry average here growth was just about 13%, so about 400 basis points outperformance to the industry average. Another important aspect and a positive one was the underwriting loss in Q4 that reduced by about 7.5%. The loss, underwriting loss came in at about 232 crore rupees versus 251 crore rupees. And the most important aspect, combined ratio, that also lowered in the fourth quarter, coming at about 102.2 versus 104.2. The management has given a very bullish stance as far as the combined ratio is concerned. They've said by quarter 4 FY25, that is exactly 1 year from now, they expect to reduce combined ratio by another 50 basis points, and doing it at already good levels, that is 102.2, would be taken very, very positively. As far as balancing of portfolios is concerned, Lombard has done that very well in the fourth quarter. Two segments, motor and fire, where the premium growth hasn't been very strong. They've sort of looked at, improving the underwriting performance, and health has come out where the premium growth has been very strong. So, of course, underwriting performance getting improved in two large verticals, premium growth coming about in one vertical, all of that balancing portfolios very well, and the numbers look strong for the company.
Thank you very much for that. The other one which is looking up today is Just Dial. This is after the company reported their Q4 numbers, and it's been a good growth quarter for the company. Revenues are up 2% quarter on quarter, and on a year-on-year basis up 16.5%. The margins have expanded significantly. Margins on a quarter-on-quarter basis are up close to about 400 basis points, and even on a year-on-year basis, you are seeing a very strong margin expansion. Margins at 26.1% is a 4-year high, and this operating leverage is driving a profit jump of 25% on a quarter-on-quarter basis and 38% on a year-on-year basis. We also chatted with the management, and they indicated that for FY25, we are likely to see a 15% top-line growth, which they said that in the current environment, given what's happening with SMEs, is a good growth number. And secondly, on margins, he said, we've ended FY24 with, Q4 FY24, Q4, not full year, with 26% margins, but it's possible for us to get back to our historical margin levels of 27 to 28%. So he sees margin enhancements, going forward, which is also some positive commentary coming in from the Just Dial management.
Positive commentary indeed, and that's reflecting in the stock price as well. There's a 4,600 crores cash on its books as well. The stock is up 9% or 10% now as we speak. At one point, it was up over 11.5%. It is the best single day gain that the stock has seen since January of 2023. So the best day in almost 15 months for Just Dial, now closing in on the 1,000 rupee mark. Is that Just Dial 10.5% higher in today's session after some really strong earnings. Moving on then, some real estate stocks in focus, and Brigade and Sunteck are those two. They're on the back of their fourth quarter business update. Sonal is joining in with more. Sonal, most of the stocks that have come out with updates, record sales, record year, does that reflect in Brigade and Sunteck's numbers as well?
It does in Brigade for sure. Brigade reported their highest ever quarterly numbers and yearly numbers as well. So to take you through them, in terms of pre-sales, it's up 53% on a YY basis. Volumes are up 18% on a YY basis. Their annual collections are up 9% on a YY basis, and the average realization on an annual basis has come in higher by 23%. The leasing portfolio as well has grown for them by 14% in FY24, which is achieving an occupancy of 97%. So that, of course, is an improvement that the company has seen. For the hospitality vertical, average occupancy stood at 72%, which is up 3% on a YY basis, and the average room rental stood at 6,480 rupees per room, which is up 8% on a YY basis. So there's a growth all across their businesses. Ambit says that they expect momentum to continue further, and they build in pre-sales of around 6,700 crores in FY25 and 7,800 crore rupees in FY26. The company says that they have a pipeline of new launches across their segments, 12.6 million square feet in residential, 6.3 million square feet in commercial, and 1.06 million square feet in hospitality as well. Moving on to Sunteck now. Now, Sunteck had been seeing some pressure in their pre-sales in last couple of quarters, but now this is a growth number that we are seeing. Pre-sales are up 26%, but collections, they have declined 32% on a YY basis. But the company says they have added 7 large projects in the Mumbai region with a gross development value of 30,000 crore rupees, which will reflect once it executes in FY25 and FY26. And that's why a green tick on the stock today.
Thank you very much for that. We'll get into a break. We'll discuss commodities on the other side. Stay tuned.
Back with us on Trading Hour here on CNBC-TV18 and shifting focus now to the commodity space. Manisha Gupta is joining in as always. Morning, Manisha. What is the commodity in focus today?
Well, I'm looking at steel because this one has been a laggard for a very long time. While the other metal prices were running up, steel has rebounded from a 4-year lows, and we have seen prices gain up by nearly 8% in a matter of last 1 week itself. When you look at the Chinese data, the month of March has seen exports numbers as well increase by nearly 25%, and that is what has led to buying happen on the Shanghai exchanges and elsewhere in the world as well. Also, when you look at the India finished steel consumption, that has been on a rise as well. Well, most experts would tell you that the major part of the incremental demand growth would come in from India. And this is a report from Steel Mint which says that for FY24, they have seen steel consumption within Indian markets increase by 13% to 136 million tons, which last year was 120 million tons. Also, when you look at the demand that seems to be coming in from EV, construction, infrastructure as well, and with elections going on, the expectation is that demand is only going to increase from here and as well. When you look at the production numbers as well, Steel Mint says that for FY24, they've clocked in a number of 12.6% on the higher side at 143 million, which was about 127 million in the year ago. For FY30, India has put a target of 300 million tons of production when it comes to steel. A final number, and this really is about the January and the month of March. So the first quarter of this calendar year also has seen production increase to nearly 33 million, which was 31 million tons in the previous year, same quarter. So whichever way that you look, the steel numbers globally are looking good. But for the Indian markets, the numbers clearly seem to be shining.
Thank you very much for that 8% jump in steel prices this week. By the way, the Nifty is now inching towards 22,300. It's a 138-point jump in the Nifty, 0.6% higher. When we started the show, it was just a paltry gain of about 0.2, 0.3%. But look at the way it's, moved up right now. Banks are holding up. So the Nifty Bank has a gain of about 250 points. Other than that, you've got strength in, Power Grid continues to be the top gainer. BPCL, Bharti Airtel, Hindalco, M&M has gone up close to about 2%. Buying is emerging in some IT names too. So LTI, Mindtree, TCS is on the gaining list. L&T is higher by in trade. Just quickly check some of these usual movers which tend to pull up the Nifty. One is HDFC Bank. Well, that's not moved too much. Reliance Industries is another heavyweight, and Reliance Industries has a gain of close to about 0.5%. So big jump in the large caps.
A sharp surge, and you can see there a lot of these index heavyweights have just recovered from the day's low, and both HDFC Bank and Reliance, if you can pull up both their intraday charts, you would see that there is a spike that has come in from the lowest point of the day. Neither of them are at the day's high, but there is a spike that has come in from the day's low, and as a result,
but it's the Nifty IT index which is mirroring the Nifty up move. So pull up the Nifty and then pull up the Nifty IT, and then you would see that a bulk of the up move has come in courtesy the Nifty IT. Well, it's true that HDFC Bank, Reliance Industries are ticking higher, but it's the Nifty IT and individual stocks there which are pushing the markets higher. Pull up and Infosys as well. Let's see whether Infi is seeing some buying ahead of its numbers post-market hours. The last couple of days, the sentiment on Infi has been a bit subdued. It's lost close to about 4-5% on Monday and Tuesday. But today, you are seeing some buying emerge. Indeed, both Infosys and TCS, they're contributing almost 20 points to this recovery in the Nifty. And as you mentioned, the Reliance and Bharti Airtel is contributing almost 17 points to the upside. But as we head into a short break, a small programming note, joining us live today from 5:30 p.m. onwards for CNBC-TV18's Future Female Forward, the Leadership Circle, a transformative platform where women leaders come together to connect, express and evolve. The circle of trailblazing women leaders from diverse fields will venture beyond the traditional discourse during this course of the discussion. This Leadership Circle is not just about business strategies and professional accolades, it's about delving into the depth of the personal journeys these women have taken. Welcome back. Vodafone Idea's 18,000 crore rupee FPO opens today. The company has already raised 5,400 crore from anchor investors. I caught up with Akshay Mundra, CEO Vodafone Idea, to talk more about the FPO details. I asked him on the company's strategy on capex to arrest the subscriber market share decline, how the company plans to increase its average revenue per user, when will tariffs be forthcoming, and the government, which is the single largest shareholder in Vodafone Idea, what's their plan?
It could be modified. That is how we see things today. And you would have seen what has happened with 5G is that on the consumer side, there is not so much of 5G use case, and monetization has been a challenge. I think when the rollout happened a year ago, there was this sense of that when 4G came out, somebody missed out, so we should roll out quickly. Can it become a factor in terms of, again, gaining disproportionate market share? Now, we've had 5G for a year. We've not seen that happening. And the major difference there is that when we moved from 3G to 4G, on your phone you could see a very big experience difference. 5G, that is not the case. The speed is much higher, but in terms of what you see on your small screen, that is not such a discernible difference. One is that the Indian ARPUs are the lowest, and I think lowest not by a small margin, by a big margin. So that is the important factor. The second thing to be kept in mind is that today none of the players are returning their cost of capital, and it has not been just a year or so, it has been 5 or 6 long years. And that was the scenario when 4G investments were made. 5G investments have added on to that, and 5G monetization is still not to be seen. So the imperative for tariff correction just to get to a return on cost of capital being there.
So what should the ARPU be for you to be able to return your cost of capital?
Again, I'm not at liberty to say that, but there is enough commentary from our peers, and I would say that
300? That's the commentary from your peers.
So that number appears to be right. New funding is largely for growth capex, and our plan to meet the existing debt, vendor payments, and the government obligation is out of internal accruals. Now, of course, we expect the internal accruals to improve as we make investments. The only thing I would say is that you are aware of the reforms package, and the reforms package has a provision that post the moratorium, the deferred installment series which is there, the government can convert that to equity. So I think this is somewhat into the future. Probably we will need government support for some time, but over a long period of time, we believe that our operations should be sufficient to meet these obligations.
The Vodafone Idea CEO there speaking to Rima at the start of their 18,000 crore FPO, the largest in the history of the country. But as something good happens with Vodafone Idea, Indus Towers automatically goes up, and it's doing very well for itself in today's trading session as well. Another upgrade for Indus Towers, Rima.
Oh yes, and now the year-to-date rally on Indus Towers stands at 75%. IFL today has upgraded Indus Towers to a buy. Their target price stands at 375. They believe that Indus Towers will be the big beneficiary of what's happening with Vodafone Idea, the capex that they're planning, their improved financial strength. They're giving 3 reasons. One, for the upgrade. One, they're saying that earlier we thought that maybe there was a chance that India is a 2-player telecom market. They gave a 75 to 25% probability of a 3 to 2 player. There was a 25% probability basically that Vodafone Idea will not survive. Now, according to IFL, there is a 100% probability that Vodafone Idea will survive. So that's reason number 1. 2, the amount that Vodafone Idea is spending on its capex will boost Indus Towers' tenancy, the number of tenants that they have on each tower. Right? So that doesn't require an incremental capex. You already have a tower, you're servicing, say, a Bharti Airtel. Now you will service that area for Vodafone Idea as well. So that's straight away accretive for their financial. And according to IFL, the tenancy will go up to nearly 2x. And third, with improved Indus Towers cash flows and financial positions, there is a possibility that Indus Towers will reinstate dividend. They've not given dividend for nearly 2 years now. The last one was in May in 2022. Till then, it was always a dividend-paying company, but it stopped giving it because of the receivables and the provisions that they were making for Vodafone Idea. So that's the third reason. And they're saying that this target price of theirs, 379, does not factor potential realization of overdue receivables from Vodafone Idea. So if that comes through, that would be the icing on the cake, I presume.
Icing on the cake, indeed. 75% now this year for Indus Towers, and this is the second best calendar year that the stock is having since it went public in 2012. Remember, before Bharti Hexacom, this was the last IPO from the Bharti Group stable there. The 12-month is even better, 155%, but 75% higher in just 4 months. That is good going for Indus Towers. And another potential trigger, Reema, is that the fact that it may be a possible MSCI inclusion as well next month. So if that transpires, that may lead to further inflows of almost close to $200 million for Indus Towers. So a lot of positive triggers. And I remember you were mentioning it was a dividend paying company, and that they had mentioned that they have to stop paying dividends because of the fact that they are not receiving payments from Vodafone Idea at that point of time. So if they reinstate dividends, that will be another positive. The MSCI, another positive. So things falling into place for Indus Towers. They're 66% in 3 months, 5.5% higher now at 350. By the way, what is also
interesting is that, one would think that if Vodafone becomes stronger, then it's negative news for Bharti Airtel and Reliance Jio, because Bharti Airtel and Reliance Jio have been gaining market share at the expense of Vodafone Idea. If Vodafone Idea starts reclaiming that lost market share, that means for Bharti Airtel and Jio, perhaps they will not be able to gain as many subscribers as they used to. But, today also Bharti Airtel is, positive. And I think here what the street is latching on to is government support, right? If Vodafone Idea has to survive, they will need some government support on their AGR dues. If that comes through, it's a positive for Bharti Airtel. So notwithstanding the possibility of slowing market share gains, Bharti Airtel is higher today.
The CEO also expressed confidence, right, that they would be arresting this loss of subscribers that we're having.
And participate in the industry growth, which means grow their market share.
If that happens, yes, of course, it will be a positive for Vodafone Idea as well. So 5.5% higher for Indus Towers. So good time to get in a technical check on the markets now. Vishal Malkan of Malkan's View is joining us now. Vishal, good morning. Thank you for joining in. It's been a bit of a choppy trade, this for the Nifty. It's nearing this first resistance zone of 22,300. Do you think it can surpass that and sustain above it on this day, which is the options expiry as well?
I think we had a rough patch in the last few trading sessions, and this is just a halt which we are facing in this downtrend. We might continue to go down and test those levels of 22,000, which is another 200-300 points away. So I think it's going to be like a dull day or a weak day today, where we can look at lower levels further.
Okay, what about stocks? If markets do head lower by 2 to 3%, would you be more bearish?
Yes, I would be more bearish on stocks, especially on the banking side, and especially in the private sector bank as well as PSU banks, where we can look at least another 4 to 5% decline in all major top-line stocks.
So what are specific stocks that you are recommending this morning, Vishal?
In case if we have to stabilize and go up, the only stock which I look at to go long in this market, which is the outperforming sector, which is metal. And I'll go with Jindal Steel, especially, which is looking very attractive at this level, with a stop of 900 for targets of 950, 970 as a long candidate.
All right, Vishal, thanks a lot for joining in and sharing with us your views on the index and on specific stocks as well. That was Vishal Malkan of Malkan's View. By the way, the small cap index continues to grow from strength to strength. It's up already 1%. The stock that is doing well, though, is CAMS, C-A-M-S, and that is surged to the highest point of the day. And that is up 6% now as we speak. And that's the top gainer on the small cap index. There you can see there CAMS. It's been good going for the stock over the last month or so, 12% higher over the last 1 month, 32.85 now on CAMS. It recently received the payments aggregator license as well from the Reserve Bank of India. So good going there for CAMS. Another stock that is doing well is PVR Inox and Ramkrishna Forgings, both of them doing very well in today's trading session. Interestingly, PVR Inox is up 3.5% despite the fate of this big mega release that happened over the holiday weekend, but it did not do very well for itself. But still the stock is up 3.5%, as is Ramkrishna Forgings, 3.5% higher, almost 20% in the last 1 month. It also received a big order recently. So good going for both PVR Inox and Ramkrishna Forgings as well. Time for a short break. When we return, we'll be joined by Anish Damania of JM Financial Institutional Securities to discuss market fundamentals. Stay tuned. We'll be right back. Back with us here on Trading Hour. The Nifty continues to find some resistance at 22,300, as a lot of the technical analysts were highlighting at the close on Tuesday session as well, that in case an up move does happen, the Nifty will struggle to cross the 22,300 mark on the upside. As you can see there, 22,295 was the day's high, but it failed to cross the 22,300 mark, currently at 22,280. But a pocket that is doing very well today is oil marketing companies, and all three of them, HPCL, BPCL, Indian Oil, all of them are outperforming. The crude prices continue to remain where they are, but these oil sensitives are doing well for themselves. 4% higher for HPCL, nearing the 500 mark, 2.5% higher for BPCL as well, above the 600 mark in today's trading session. It's not done a lot over the last 1 month, but in today's session it is turning out to be an outperformer. And Indian Oil as well is also trading among the gainers in today's trading session. So good going there for the oil marketing companies. And shifting focus back to the markets now, we are joined by Anish Damania, the MD and CEO of Institutional Equities at JM Financial Institutional Securities, to discuss the market fundamentals and a lot more. Anish, good morning. Thanks a lot for joining in. I'd like to start off with oil marketing companies since we were on that subject. There has been plenty of divergent opinion on the prospects of these companies. Now that the crude prices are also going higher, which side of the fence do you find yourselves on?
So, as a house, we believe that in terms of the oil marketing companies, the best of the year has gone past them, and if we normalize the year, then the stocks trade very expensive versus their average earlier, and still, we see there's uncertainty on the oil prices. So we feel that at this current time, these stocks are fairly valued.
Anish, morning, Reema here. We'll get to the capital markets, you're the head of ECM2 in just a bit. But since we're on the subject of oil marketing companies, as a house, where is it that you're most bullish on over the next 2 to 3 years? Because stock markets tend to front run the good news and price in the good news well in advance. And we've seen that happen. So where is the risk reward? Where are you most confident about to make money from here?
I think if you ask me about the oil and
not oil and market. I'm saying just to get the market view out, in place first. So as a sector, as other sectors.
So from our perspective, we bet a lot more on ONGC than the oil marketing companies at this point of time. We also bet on the gas companies and companies like Petronet LNG and the Gas. We feel that those stocks offer a lot more value, and at this point of time, we feel that the OMCs are fairly priced. I think this is a view which we have at this current moment of time. But if, let's say, oil prices continue to stay in the $70 to $80 band, maybe there could be some tweaks which we might have on that view.
And the other sectors which you like?
Yeah, so overall, if I look at the market, then we are very positive on banks, the entire manufacturing sector. I think there is a need to look at the consumer staples. There has been a long underperformance of that sector. Over the last 2 years, incomes at the lower and the mid strata of the society has been not that great, and which is reflected in the kind of consumption patterns which we have seen. But we feel that we probably are scratching that bottom, and there could be this bottoming out phenomena. This could be a good time to look at the FMCG companies as well.
What about IT, Anish? The street has not taken very well post TCS's results, although the management commentary was fairly okay. They said FY25 would be a better year than FY24. Deal wins were at a record, but then there is still this near-term lingering uncertainty over what's going to happen in North America, in the US, and the street is almost on the edge now when it comes to Infosys' results as well. Where is it large cap IT or is it mid cap IT? Do you find value there, or do you find even value at all in this sector?
I think there is value emerging in the large cap IT space, especially the IT services companies. There has been a lull in the consumption, the spends which which the end customers have done, and probably that could continue for another few months. We feel that there is just a postponement of that trend. And at this current point of time, we are not that positive on an Infosys or a TCS, but definitely in the mid cap space, we feel that since their growth is structurally looking at 14 to 15%, which is almost 3 times the the growth rate of the large companies. And given the very large weights, we have a 14 to 15% weight in the index for IT, and most of it is dominated by the large services companies. And we feel that the alpha generation is happening in the mid-cap companies, and that will continue. So in the IT space, if you continue to ask me to bet on, I think the mid-cap IT companies will continue to do well. And as long as there could be supply in that supply can get easily absorbed in those names. So overall, at this point of time, we are neutralish on this sector. We feel that the stocks have come off and they have kind of taken into cognizance the fact that there is a lull in the market. So there is some bit of expectation that this lull will continue. We believe that this might continue for another 2-3 quarters. We need to revisit this view now. And we feel that this could be a time where we can look at it. But at this point of time, we are still looking at how to position the large cap IT companies. At this point of time, we are still negative on that.
Okay. Anish, and what's your expectation from the capital markets in terms of M&A, QIP? India has become a magnet for inflows. So what's happening on that front?
So just if you look at FY24, we had about 2 lakh crores coming from both FIIs and DIIs each. We had about 1 lakh crores coming from PMS, AIFs, etc. So about 5 lakh crores. Add to that, the family offices are also added to this bit, and also retail. On the supply side, if you see, we had IPOs and QIPs together about 1,50,000 crores. We had blocks which the Ps and some of the corporates sold down of about $20 billion, or another 150,000 crores there. And you had OFS from the government and others about 25,000 odd crores. So a supply of about 3,25,000 crores, and money was about 5 lakh crores. So you can imagine that 1,70,000 crores, which went into the secondary market, caused a 28% rise in the Nifty. I think this scenario is not changing. So despite the seemingly large supply of paper, which could be both, I think the QIP will accelerate this year. We think the QIP amounts could be 3 times of what was raised last year. And IPOs will continue to raise about 75 to 1 lakh crores, 75,000 to 1 lakh crores. I think even despite this, we feel that the inflow of money will be higher than the supply of this paper, and this will keep the markets buoyant.
That is some number, 75,000 to a lakh crore in the IPOs in this financial year, as if the last financial year was not enough to go by in terms of numbers. But pleasure speaking to you as always, Anish. Thanks a lot for sparing time and joining us this morning. That is Anish Damania there from GM Financials. Time for a short break here on Trading Hour. When we return, we throw the spotlight on the banking sector and understand what lies ahead for the fourth quarter. We'll be joined by JP Morgan's Saurabh Kumar. Stay tuned. We'll be right back. Back with us here on Trading Hour on CNBC-TV18. Pull up the Nifty Auto Index, and along with IT, that index has also seen a bit of a spike as we towards in the last 5 to 10 minutes. There you can see 1% higher on the Nifty Auto Index, and also doing well is Bajaj Auto. That is leading the charge on the Auto Index ahead of its results today. The results are also expected after market hours in today's trading session. So 1.5% higher for Bajaj Auto, back above the mark of 9,000. So good going there for the Auto Index as well. And as Anish was highlighting, some FMCG stocks also, the FMCG index is also doing well, slightly recovering from the lowest point of the day, but it was one of the underperformers. There you can see there 0.3% lower for the FMCG index, but off the lowest point of the day. But in our special segment now, quarter se quarter tak, we bring you the earnings expectations from each sector, and today Abhishek is joining in, who will tell us the expectations for the banking sector this quarter. Abhishek, take it away.
Well, in Q4 FY24 for the banks, if you take a look at the loan growth, as on 22nd March 2024, banking sector witnessed a loan growth of 20.1% YOY and about 3% quarter on quarter. Low cost deposit, that ratio has been declining for last few quarters, and you can expect the downward trend over there to continue in Q4 FY24 as well for many lenders. Net interest margin will decline for many lenders as cost of funds will continue to rise for them. There can be operating profit growth rate slowdown, largely due to decline in net interest margin as well as lower trading gains this time around. So credit costs to remain under control on account of the fact that there will be lower slippages as well. Earnings will be under pressure. You may see decline in some earnings for some of the lenders. Banking sector is witnessing the best of asset quality in over a decade, and it will continue to remain in a sweet spot even in Q4 FY24. So you can expect the slippages to be on the lower side. However, also expect recovery and upgrades to be on the lower side this time around. Now, the key highlight will be the deposit mobilization, as it has lagged loan growth for last few quarters in a row. Hence, lenders' outlook with respect to focusing on deposit growth or slowing down the loan growth will be seen closely. Key estimates from Kotak Securities for some of the lenders are, for SBI, they expect NII to be down 0.5% YOY but up 1% quarter on quarter. The net profit will be down 21% YOY and up about 43.6% quarter on quarter. For Bank of Baroda, Kotak Securities estimates NII decline of 2.2% YOY and up 1.5% quarter on quarter. On net profit, they expect it to decline by 7.2% YOY and about 3.2% quarter on quarter. For SDFC Bank, I've taken only quarter on quarter because there was a merger of SDFC Limited. So NII is expected to be up 3.5% quarter on quarter, while net profit is expected to be up 22.3% quarter on quarter. Remember that there will be a large other income in SDFC Bank for the stake sale that they have done. ICICI Bank NII is expected to be up 3.7% YOY and a decline of 1.9% quarter on quarter. Net profits are expected to grow up by 4.6% YOY and a decline of more than 7% quarter on quarter. For Axis Bank, Kotak Securities estimates NII to be up 8.9% YOY and 2.1% quarter on quarter, while the net profits are expected to decline by 1.7% YOY while grow up by 0.7% sequentially. Back to you.
Thank you very much, Forward. Let me also invite Saurabh Kumar, Senior Analyst, India Banking and Financial Research at JP Morgan, to take a few questions. Saurabh, morning. This is Rima here. First, if you could lay out your top 3 expectations from earnings this time for the sector.
So I think on the earnings, I think the main question will be how the LDR ratio, credit deposit ratio trends. So we have seen these initial numbers coming out at banks. So obviously the reduction, there has been some sequential reduction which has happened across a few, but I think that will be the main. The second will be basically we do expect some rise in credit costs, especially in the unsecured business. That will be the second thing to watch for. But the biggest number basically, because this is Q4, Q4 is also seasonally strong across banks. I think the guidance or whatever banks can give color on next year growth, loan growth and balance sheet growth will be key, because these banks are now, in our view, going to get priced for growth, because the credit, in our view, for Indian banks remains one of the cleanest in Asia Pacific. So what we're really betting, the investors will really be betting on growth.
So sort of just addressing each of these 3 in greater detail. So first, on the credit to deposit ratio, by how much will it come down by? And is that something which is going to continue? And then even on the credit cost in unsecured lending, what's the increase that we should expect?
So I think broadly for banks where the LDRs were stretched, let's say above 90% one would expect some moderation to continue to happen. But banks where the headroom was there, let's say they were below 90 or below 85, I think there is some headroom for them to kind of accelerate. On credit costs, we think broadly, I mean, depends on each bank, each NBFC, what the exposure to unsecured loans is. But broadly, given baseline, I think 15-20% worsening, which is very near term, could happen on the unsecured book. So that will be the baseline expectation where I think markets will start off with, and we'll kind of build from there. But I would also point that Q4 is seasonally strong for asset quality in other segments. Corporate is going to be 0 to negative, I think, on MSME and other pieces. Things will remain pretty benign. So credit quality is less of a concern for us right now, unless the bank is significantly exposed into unsecured loans.
You know, Saurabh, before these business updates came out earlier this month, there was a lot of talk going about the banks facing some deposit growth challenges going forward. But the deposit growth this quarter has been fairly robust for most of the banks that have come out. Do you see this as a one-off, or do you see these trends sustaining going forward as well?
Yeah, so our view is that, look, given at a macro level, we don't think that deposit at a country level will be a problem. At a system level is going to be an issue. The issue is low cost deposit. So obviously CASA growth remains the biggest challenge and the biggest monitorable because CASA growth is the main constraining factor. But deposit growth, I mean, if you look at the latest prints across RBI, the deposit growth is printing up eventually over a 3-4 year basis. Both credit growth and deposit growth do normalize. Our view is that, look, money is not leaking the country. BOP continues to remain positive. So we are less concerned about deposit. It's just a matter of rates which you pay. And banks had run up, in our view, LDR a bit more opportunistically, given the rate cycle was speaking out. But yeah, on the total deposit growth, we are less concerned. But yes, CASA growth is the main monitorable to our view.
And PSU banks are best positioned on the CASA growth front? And between private and PSUs, I know you won't talk individual stocks, but between private and PSUs, what would you guide investors? How should they think about it?
So CASA growth, obviously, I think it's an issue for the system. I think private banks may do marginally better than PSU banks. But broadly, the thematic we are basically playing is by the corporate banks in India next 3-4 years are going to be great for the corporate banking cycle. Larger private banks run largely balanced businesses between corporate and retail banking. SOE banks tend to be more exposed into corporate banking. So that remains the trade to our mind, that you buy PSU banks for the credit, but stay back for the growth.
And FY25 growth expectations on the loan growth front, what are you expecting?
So we expect system credit growth to be about 13% and the individual banks, depending on the bank, can do 200 or 300 basis points better.
What about the larger private banks, Saurabh? I know you don't want to talk specific stocks, but there has been a lot of these merger-related issues with the largest private lender as well. A lot of these other private lenders, some of the peers as well, have highlighted some challenges. Where do you stand when it comes to larger private banks compared to the mid-sized ones? Do you find value in either of these pockets?
Yeah, so large private banks are on a price earnings, price to book relative to the normalized ROEs and the normalized growth that these banks can generate. To our minds, do look attractive relative to where the other NBFCs and the smaller banks traded. And obviously these banks, in an environment where deposits are constrained, where you risk some level of, let's say, lower CASA growth, some slightly higher rates on term deposits, these banks will be better positioned in our view. So given the valuations, given the growth, I think your cohort of large cap privates relative to even the market do look attractive.
Pleasure speaking to you, Saurabh. Thanks a lot for joining in and sparing time and sharing your views on the expectations from the banking earnings that are expected this quarter. That was Saurabh Kumar there of JP Morgan. By the way, flashes on your screen that were coming in from Mastech, and it has been named as one of the companies in some UK digital project, and that stock has surged 17% as we speak post this order win that Mastech has won. There you can see there a sharp spike coming in from Mastech. They're 17% higher now, well above the 3,000 mark. We'll get you more details.
Mastech also reports numbers today.
Oh, so it's a double delight, I guess, for Mastech. So some good news coming in for Mastech on the order win front, and numbers are awaited as well. So 15% higher for Mastech. But as we slip into a break, we have an announcement to share with you all. We are launching CNBC-TV18's first live personal finance webinar, the CNBC-TV18 Accelerate the Personal Finance Handbook with Sonia Shenoy, where she'll be joined by 3 well-known experts on Saturday, the 11th of May at 9 a.m. onwards. We'll be diving into everything you need to know to master your your finances and learn how to grow your wealth, be it insurance, tax savings, managing your portfolio, retirement planning. There is a lot to learn and lots to do as well. Whether you're in your 20s, 30s or even 40s, this live webinar is for you. We have limited seats, so don't miss this chance. Register now. Scan the QR code to register or log on to CNBC-TV18.com, and we'll see you on the 11th of May. Back with us here on Trading Hour, shifting focus now to some important earnings today. Bajaj Auto is expected to report a strong set of fourth quarter numbers later today. Sonia is here with the details. Sonia, good morning.
Good morning. Thanks a lot for that. So, the Bajaj Auto stock has done so well, right? It's up almost 75% in the last 6 months. It's expected to report a very good set of numbers. It hit a record high of 9,356 on the 2nd of April 2024. Now, just to go through the numbers very quickly, Goldman Sachs, in fact, recently raised their target price on Bajaj Auto. They're expecting a very strong volume growth, a pickup in the export business, as well as better quarter-on-quarter three-wheeler performance too. Now, if you're looking at the key numbers, 24% volume growth is what the CNBC-TV18 poll has thrown up at 11,118 crores. The EBITDA is expected to go up by almost 30%. The margins are expected to improve 50 basis points because of better operating leverage, while the profits are expected to go up by 30%. Now, what's happened this quarter is that the volume growth has been very strong. In the domestic business, the total volume growth has come in at 28% for the domestic business. But the important bit is that even in the export business, there's a recovery coming through. Exports have grown by 19% year on year. Couple of export markets like Africa and South Asian regions have improved on the back of a lower base, and the margins will expand 100 basis points. But important to, 50 basis points year on year. But important to remember that the stock has also rallied quite a bit. Valuations are now on the expensive side compared to some of its peers. So we will wait for management commentary on whether this kind of growth is sustainable and whether export markets will pick up further. The numbers come in post-market hours today. Back to you.
And we'll await all these numbers. Thanks a lot, Sonia, for joining in. And after Bajaj Auto, the stock to watch out for is Infosys. That will also be reporting its fourth quarter results later today after market hours. Rima is here with the key expectations. Rima, fill us in.
Thanks so much for that. So Infosys is likely to report the second consecutive quarter of a top-line decline. So this quarter, according to the CNBC-TV18 poll, dollar revenues will be down 0.3% on a quarter-on-quarter basis. In constant currency terms, it will be a decline of close to about 0.5%. Margins then. EBIT margins is seen at 20.7%, a slight improvement compared to what we've seen in the past. Now, this quarter, there will be a 2-month incremental impact on margins due to wage hikes, but that will be offset by the company's cost optimization plan, the Project Maximus that they have undertaken, and this will drive about a 1% increase in the company's profitability. Now, the key is going to be the FY25 guidance. The expectation is the company will guide conservatively. Last year, FY24, the company had to lower their guidance multiple times. Accenture too has sounded fairly cautious. So the broad range of growth expectations that we've got is between 2 to 6, but expect a guidance somewhere between 3 to 5% for the next year, and on margins at 20 to 22%, similar to what we've seen last year. Now, Infy had outperformed TCS from FY20 to FY23 every single year. It's only in FY24 that Infy is likely to, growth is going to be weaker than that of TCS. But is that a trend which will continue in FY25 too? What else will we track from the numbers? The headcount. The headcount of the company had declined for 4 consecutive quarters as of Q3. There was also a hiring freeze at campus. So we'd want to know if the company this time sees a demand revival and therefore there is a need to go out there and hire freshers. Outlook on spending, discretionary demand. Will the company call out an AI pipeline like TCS did when TCS said that our AI and Gen AI pipeline is about $900 million? So that's also what we will watch from the company. Back to you.
Watch out for all of these numbers, and Infosys will be the earnings to watch out for, along with Bajaj Auto this later this evening. And before we call time on this edition of Trading Hour, the Nifty remains around the 22,300 mark, with the IT and the auto indices continuing to remain in focus. But the sector of the day so far has been the metals index, and that has surged to the highest point of the day, now more than 1.5% higher for the Nifty metals index. So the metal stocks continue to grow from strength to strength. Almost at 9,000 now is the Nifty metals index. But with that, it's a wrap on this edition of Trading Hour. From Rima, myself and the team that put this show together, thank you so much for watching. Halftime Report takes the action forward.